So moving on here, I just wanted to introduce our guest, Dana Sheridan. Dana, are you there?
I am. Good morning.
Good morning. Dana has been involved in risk management for almost 2 decades. She's an attorney, has a degree from William Mitchell College of Law. She's a member of the California Bar, the Minnesota Bar, the U.S. District Court for the District of Minnesota, and the Central and Northern and Eastern Districts of the federal courts in California. So she's a frequent speaker to the U.S. and Bermuda-based insurance carriers on coverage issues, marketplace, and legal trends. She was also recognized as a 2011 top lawyer and elected as a Southern California super lawyer rising star in 2007, 2009, and 2010. So welcome, Dana. Dana.
Great to be here.
We talked before the show, and we were talking about the pronunciation of Dana's name, and I was afraid that I would misspeak, and I sure did.
That's okay.
I apologize.
Oh, no worries. Once you know a Dana, it's hard to remember Dana.
All right. So, we have time for a couple of these questions, I think, here that I wanted to get into with you. So we wanted to be pretty basic on our show today, and try to do some good, solid education on captive insurance. So let's start there. What is a captive insurance company?
A captive is a wholly owned insurance company that insures the risks of companies affiliated with the shareholders of the captive. Just for some fun facts and trivia, about 50% of the Fortune 1500 companies have a captive, and at this point in time, there's about 6,000 of these worldwide, with about 2/3 of that 6,000 owned by U.S. citizens. So quite the majority percentage are owned by, folks that are based or run businesses out of the U.S.
Okay. And so, let me clarify that. So if I have a business and I have several clients that have captives, so this isn't really something that's just in one business sector. It can be, it's across the spectrum. Is that right?
Oh, absolutely. All different kinds of industries have captives. Some industries are better served by captives. One that immediately leaps to mind is the construction defect. Anyone who's ever been anywhere near a commercial carrier on a construction defect claim really would should think about utilizing a captive for some of that defect-related, self-insured risk. But really, any industry can qualify to have a captive.
Okay, and what industries have you seen it in, or which industries do you cover at Active Captive?
Oh, we've got quite a few. We have people with stop-loss, medical stop-loss in captives. We have quite a bit of real estate owners and developers. We have a lot of technology industries and a lot of medical, a lot of people in doctors, lawyers, medical, pharmaceutical. I mean, you name it. We manage captives across the board. It really just depends on, whether you have sufficient cash flow to sort of justify having a captive, some ownership structure related issues, and then really that you have quite a bit of self-insured risk that you could easily put inside the captive to make sure that the captive is a real insurance company. It needs to have a legitimate risk management insurance-related purpose and really can't be created just for some of the gorgeous tax or wealth benefits that exist for captives.
Okay. And, I wanted to kind of highlight what you just said. And we're going to separate the discussion today. into two distinct areas. So, one, from the insurance and risk management perspective, which is the reason that you set up a captive. But second, discuss the tax and wealth management benefits of having the captive. In my introduction, I hit on both of those, but I just want to focus on so that our discussion is kind of in those two sections. So from the insurance and risk management perspective, let's talk about that. Why form a captive from that perspective?
Well, the chief purpose of a captive is always for risk management or for an legitimate insurance-related benefit or purpose. As attractive as tax or wealth management benefits are, and believe me, these are very attractive, they have to be secondary to a legitimate insurance-related business purpose and risk management function. Some of the other insurance-related benefits that are pretty nice here, you can lower your insurance costs by premium placement through your captive. And captive has a lot of flexibility to write its policies. You can really design captive policies to specifically fit the risk of the insured, which is something that the commercial market just can't do. They can get close in some instances, but commercial market carriers certainly do not have the flexibility to write coverage the way a captive can. And a captive can eliminate, for example, routine coverage limitations or exclusions that would otherwise exist in commercial market policies. In fact, that's one of the chief reasons why people might choose to go captive is because the commercial market just can't cover all their areas of risk or liability, and as a result, they're taking on some of that risk or liability far too much as a self-insured function. And then also you can manage your claims administration with a lot more ease out of a captive than what you would experience with a commercial market and submitting a claim to a commercial carrier.
Okay, so I think something that might be interesting to our listeners is, could you just give us an example of how a captive has benefited one of your clients, so that, because you just explained in the commercial markets, things are difficult to insure against sometimes. So give us an example of a captive that you've set up and how it's helped when there have been claims for one of your clients.
Well, actually what springs to mind when you ask me that question is an experience that I had when I was in law firm practice. Prior to joining Active Captive, I was an insurance coverage litigator in a law firm for about 16 years. And some of the claims that I worked on, I always represented commercial insurance companies. And some of the cases were against insureds seeking to establish whether or not there was coverage under the policy. And one of the cases that really sort of sticks in my head and always really has was this large construction defect-related case that was condo conversions in South Carolina. And what I remember about that case is there were multiple insureds, so it was a whole series of real estate owners, developers, general contractors, subcontractors. And I represented a commercial carrier that had issued quite a few primary level policies for these insureds. And these insureds had quite an elaborate commercial program of property and casualty insurance and specialty lines insurance. And they were sued in this huge case. It was over $30 million in construction defect. And there was only a single carrier that came to that insured's defense, despite the fact that they had purchased commercial lines out of, 20, 30, 40 different commercial carriers over a span of a 10-year period. Those insureds would have been really happy had they had a captive. And they could have put some pre-tax dollars away over time because their commercial program really failed them in coming to the defense. And it failed them because commercial policies aren't designed to cover this kind of case. Construction defect or long-tail losses are heavily subject to exclusion under commercial policies. So I remember how hard it was for those insureds to understand the coverage defenses. Legitimate though they were, I remember that, it's hard when you've paid years and years and years worth of premium to a commercial carrier, several commercial carriers, and then you get sued in a really large lawsuit, and only a single insurance company comes forward. That's painful. That
would be. We've got a lot more questions to go through here, but we need to take a break right now, so let's do that, and we'll get back right after these messages.
When it comes to business, you'll find the experts here. Voice America Business Network.
Live well and leave a legacy. Durfee Law Group offers dynasty estate planning and asset protection services, so you can do just that. We focus on helping our clients gain maximum protection and privacy by providing the right tools and innovative strategies to sustain both immediate and long-term success. Call us today to set up a complimentary consultation. Call 480-324-8000. That's 480-324-8000. Or visit our website at www.durfeelawgroup.com. That's DURFEE lawgroup.com. We'll help you turn the gift of wealth into a blessing for your heirs rather than a curse.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are tuned in to What About Wealth with Rich Bloomfield and Rick Durfee. If you have a question or comment about our program, please send an email to info@whataboutwealth.com. That's info@whataboutwealth.com. Now back to Rick and Rich.
Welcome back. Again, this is Rich. Rick is on vacation today. And we're here with Dana Sheridan from Active Captive Management. We've just talked about one of the reasons to form a captive, and just real quickly, Dana, tell us about from the estate planning and wealth management perspective, why would we form a captive?
Well, at the insured level, a properly structured captive will allow for deductions of premiums. So, when you're buying policies from a commercial market, those premiums aren't tax deductible, but when you buy policies from your own captive, the premiums are, assuming that, you have a properly formed captive with a real risk management purpose. At the captive level, there's a couple of different deductions that are attractive. If the captive does $1.2 million or less in premium, it could take what's called an 831B election, where the premium gets paid into the captive and then it's tax-exempt underwriting income inside the captive. If you do more than $1.2 million in premium, then you could get deductions for loss reserves as opposed to having tax-exempt underwriting income. It really depends on the structure, and then whether or not you want to make an 831B election or wait for a different type of deduction as against loss reserves.
Okay, so just because I know some of our listeners may not, they get a little lost when we start talking about tax code here. So I'll just clarify quickly on that. So under 831B, if you set up a captive and make that an insurance company and make that election, what that means is that you can pay in premiums of up to $1.2 million per year to purchase these policies that we've been talking about to cover risks that you may have in your business that you may just be living with now or whatever. And so that election allows you to do that, and it simplifies the whole process of having an insurance company. At least that's my perspective, and so if you make that election, then you can deduct $1.2 million, assuming that you have risks that justify those premiums, and you can do that every year. So, right. And then the loss reserve thing is what you do. For some of my clients actually have the larger insurance companies, and
Right.
not surprisingly, they're in the industry that you've just been talking about in construction because they have enormous risks. So, okay. So, what would be a perfect candidate for a captive then?
A perfect candidate for a captive would be, and it really depends on the premium amounts. If you're going to do, say, an 831B or a $1.2 million in premium, owners that have a profitable operating company that generates free cash flow of about $1.5 million or greater are sort of ideal from a monetary perspective. That said, there are smaller captive structures like an SBU that could accommodate lower amounts of premium. I think $200,000 is about the lowest you could go premium-wise. Your operating company needs to hold substantial self-insured risk. It can't just you can't just push everything from the commercial market, any commercial market coverage, into the captive as well. You need to be paying significant third-party insurance premiums in the commercial market. There needs to be some space, that you're filling. You need to be covering a real risk management purpose inside the captive, and then you have to have enough cash flow to be able to afford the premium for whatever you want to write through the captive.
Okay. So I've had a number of clients, as I mentioned, that have set up a captive. Not surprisingly, many of them in the construction area. There were the captive became a little difficult for them during this most recent downturn. So explain to us how that works. If you set one up and you're doing a lot of business, you have lots of risks that you're covering, and then you hit a downturn and pretty much business goes to zero. What happens to the captive?
Well, you can change your premium amount year to year to year, dependent on your risk, dependent on how much insurance you want to buy from your captive, and you can also, take a break and not do any premium in any particular year. And that could be driven by a number of factors. Maybe you just don't need anything that your captive was writing from an insurance perspective, or maybe you just can't afford insurance the same way you used to in years previous. Ultimately, if the captive is around for too long without doing any premium, you're going to want to perhaps consider shutting it down. But you certainly don't have to feel like you're locked into doing the same amount of premium year after year after year after year. And in fact, in some years, you just might not be able to, because every year when you renew through your captive, whoever's assisting you with the renewal, whether it be a company like Active Captive that would be your manager, or whether it would be like a TPA. Sometimes people utilize TPAs for that function. The point is everybody, whoever's assisting or facilitating the renewal will look at your risks for that year and will help you decide how much premium to do, and that'll be based on risk in that current year, what your commercial program is doing for you in that current year, and then also what kind of premium you'd like to put through the captive, monetarily wise.
Okay. So one other clarifying question. So let's say that you put in $1.2 million and you went through the year, you didn't have any claims, and so now the insurance company, your insurance company, is sitting there with $1.2 million. What does a typical captive owner do with that money that's just sitting there?
Well, what happens is you purchase your policies from your captive. The $1.2 million goes in as underwriting income. A portion of that money is held as reserves against claims, and that's what's held as reserves is supported by actuary or other studies. So you take a piece of it, and the piece that's held as reserves is liquid, so that you have an ability to pay claims should claims happen. But when the policies run off, then the money is now no longer earmarked towards reserves. It becomes available for investing. And how you invest the money inside of a captive really depends on the state in which the captive is domiciled, in part because captives are real insurance companies. They're subject to regulation just like a commercial carrier would be. And some of that regulation is, what would be a proper use of, or what would be an allowable asset inside a captive. certain types of captive structures, like peer captives, have a little bit of freedom in terms of allowable investments. But really, inside each state insurance code, there's a whole list of do's and don'ts relative to investments. And you're probably going to have to go back to regulators and just make sure that whatever you want to do with your investment-related money is proper per whatever insurance code would apply to your captive. And you will be taxed on investment income. That will not change. That's the same rule for captives as it is for other companies.
Right. So even though the premium income you're not taxed on, when those premiums are invested and there's a return, that is taxed. So
absolutely. Right.
All right. Okay, so what is a hard insurance market versus a soft one, and why does that matter?
Well, as they say in the insurance industry, you're supposed to enjoy the soft markets and brace for the hard. And the reason that I'm sure you're bringing this topic up is because one of the things we talked about this morning is how, there's been a lot of stress by me over real insurance, real risk management purpose to the captives. So it's important to understand what the commercial market is doing, what they're pricing at, what they're writing, so that you can figure out, your captive manager can figure out for you, and your captive can figure out exactly what kind of lines should be placed inside your captive. So a soft market is a classic buyer's market where policies are written favorably towards insureds, and a hard market is a seller's market, which is generally favorable to insurance companies. And the bad news here is that insurance industry market cycles typically last from 2 to 10 years, and our market began firming up in 2011 after about 8 years in a soft market. Soft market cycles are great in that you get some really creative policies written in soft market cycles. That's why, for example, we had this boom in really fantastic cyber-related forms. Companies were very creative in figuring out how to write cyber risk during our last soft market. But like I said, bad news here. By the end of 2012, the soft market was starting to bottom out, and we're now at the beginning of a seller's market or a hard market cycle. Bad news just in general for insurers.
Okay.
So we're continuing the depressing theme.
Well, sometimes the economy's that way.
Yeah, and that's a good point, because that is part of the reason why we're entering into a hard market is because of the economy.
Uh-huh. So is that the only reason that we're facing a hard market right now?
No, it's partly because we're still dealing with the residual effects of the world's economic downturn, but it's also because we've had a lot of large weather-related events in the last few, insurance market cycles, like Superstorm Sandy, and those big cat losses always have a real impact on the market. And so the combined, factors of the economy and what's going on with the economy from a global perspective, and then also with some big cat losses flowing through the market, are starting to really firm things up. And just in general, commercial market rates are drifting upward across all lines thanks to an interest rate environment that's making it really hard for insurance companies to produce investment income with earned premium. So there's quite a few cyclical factors that lead to, the changing of a market from, soft to hard or hard to soft. And it doesn't happen overnight. It takes a while for it to stretch into a different market turn, but we're definitely turning here.
Okay. So what does what exactly does that mean for captives, that we're going into this hard market cycle? We just got a couple of minutes before break, but let's talk through that.
Well, what the commercial market is doing as far as writing risk in lines is really sort of a backbone consideration. It's a great place to start when a company is thinking about whether or not it wants to go captive, because what you can and cannot procure from a commercial market is important, because the captive exists to really fill the holes in your commercial plan. Like I said, you really don't want to replace what you can buy from a commercial carrier with captives. You're supposed to have sort of three things: a risk management, internal controls, and compliance plan for your business. It really doesn't have anything to do with insurance other than it has an insurance component to it. And then you have commercial policies that you buy to the extent that it makes sense for you to do that. And then whatever you can't fit in your commercial market program, whatever is heavily subject to exclusion or you just can't buy or is cost prohibitive, that's what you would utilize your captive for. So between the three of those things, good internal controls, good internal compliance, a commercial market program to the extent that it's available to you, and then third would be your captive to really make it, perfect circle.
I think we'll go to a break here, and when we come back, I do have a listener question for you, and so we'll tackle that right after this break.
Great.
When it comes to business, you'll find the experts here. Voice America Business Network.
Live well and leave a legacy. Durfee Law Group offers dynasty estate planning and asset protection services, so you can do just that. We focus on helping our clients gain maximum protection and privacy by providing the right tools and innovative strategies to sustain both immediate and long-term success. Call us today to set up a complimentary consultation. Call 480-324-8000. That's 480-324-8000. Or visit our website at www.durfeelawgroup.com. That's DURFEE lawgroup.com. We'll help you turn the gift of wealth into a blessing for your heirs rather than a curse.
Voice America Business Network. The bottom line in business.
You are tuned in to What About Wealth with Rich Bloomfield and Rick Durfee. If you have a question or comment about our program, please send an email to info@whataboutwealth.com. That's info@whataboutwealth.com. Now back to Rick and Rich.
Welcome back, everyone. And in addition to the email address that was just given, you're always welcome to call us at 480-324-8000 and set up a time. Give us to meet. We're happy to meet, discuss, meet over the phone, discuss your questions that you may have about our show, or you're always welcome to call in a question as well as email. Welcome back. We're here with Dana Sheridan from Active Captive Management. Dana, we have a question here from a listener. This listener is in a partnership, so there's two of them apparently. They've executed a buy-sell agreement so that if one of them dies, is not there, then there's a funding source to get money into the business to buy out the decedent's spouse or family. So the question was, is a captive the best place to purchase life insurance to fund that buy-sell agreement?
Generally, no. Life insurance in a captive is a pretty controversial idea. You can do low levels of life insurance as an asset. It depends on the domicile, the state that's regulating the captive, and whether or not they would allow life insurance as an asset. Generally speaking, just as a rule of thumb, you really shouldn't have any asset in the captive that's over 10%. So you certainly can't do high levels of any particular type of investment of any kind. You need to have diversity in your asset base, and life insurance in a captive is somewhat of a controversial issue. Again, you can do some of it in some domiciles, but you certainly can't do 80% of your assets be life insurance.
Okay. All right. So probably not a good idea for a buy-sell. And the commercial markets are really pretty good for that kind of thing, and that's probably the best place to do it.
Right. That sometimes is the answer. I mean, there's sometimes, again, circling back to one of my earlier points, your captive exists in a space sitting right next to what the commercial market can do for you. And what you need a captive manager for is to sometimes help you figure out where does something best fit. Does it best fit as a business asset or a captive asset? Does it best fit as an insurance risk that you get covered in the commercial market, or does it best fit as an insurance risk where your captive is the one to write the line? So if there's a symmetry and a cohesion between, your business practices, your commercial market, and your captive, that is really an ideal world.
Okay. So, what is forecasted as being the biggest claim risks or trends from now into 2014?
Well, sadly, P&C cat loss lines are pricing upward across the board. And this is, again, bad news for those in the construction industry where construction risks, pharmaceutical manufacturers, medical device companies, mining, utilities, energy companies, these types of industries are continuing to present challenges to the commercial underwriting market because of the potential severity of any claim that could hit them at any given point in time. So what we're going to see for those industries are rate increases in their premium lines, higher self-insured retentions, which can oftentimes be a really big problem, and even more coverage limitations inside the policies that they can procure from the commercial market. A nice thing a captive can do for you is you can put your self-insured retentions or your deductible amounts through your captive. So that is one thing that we've been watching is pricing on cat loss lines, and then some of our captives, some of our potential new captive clients have come to us for this very reason. They're worried that they're going to be buying some isoform CGL coverage, for example, and that's going to be heavily subject to exclusion, and they're worried that they may want to build up some base of pre-tax dollars inside their captive to sort of get ahead of a long-tail claim, the curve of a long-tail claim, where they're worried a few years down the road their commercial program won't cover that claim.
Mm-hmm.
Healthcare reform is another one. We are all talking about and thinking about healthcare reform, and the truth is that the cost of employee benefit coverage is going to be on the rise, and insurers are going to pass that cost of regulatory compliance under healthcare, the mandates of healthcare reform. They're going to pass that right down to the insureds via increased premium. So, employee-related benefits through a captive can sometimes be complicated. If you want to direct write those benefits, you have to go through a Department of Labor exemption process. It can take quite a bit of time. But something that's relatively easy to do is put your medical stop loss through a captive. And your captive can cover that at lower attachment points and at better price points than maybe even the commercial market could do for you.
So, since that is such a hot topic right now, explain to us what the stop loss. Explain that so that listeners that aren't, in the HR area of a company might understand what's going on with that.
Well, with stop loss, what's attractive, the most attractive feature to putting it through your captive is a lot of times, when you have these employer-employee plans where a portion of the claim is covered by the employee and a portion is covered by the employer, that's a big cost. It's a big insurance cost to the employer depending on how many employees they have and what program. And a lot of times, in order to insure against large claim losses, you have an outside commercial program that provides you some help through a stop loss program. And the attachment points for the stop loss can sometimes be pretty high and cost prohibitive depending on your claims history with your employees and whether you have a lot of employees that have put some pretty big claims through your medical program. What a captive can do is cover shorter, smaller layers. So like, say, if the employer's attachment point on any particular claim is like $5,000, $10,000, $15,000, you could start your medical stop loss through your captive and start putting those claims through the captive. And then sometimes as a complement to that on the back end, you can have commercial stop loss at a higher attachment point. So you cover in the middle piece of it through your captive is one way to do it. You can do all of the stop loss through the captive. It really depends. And because stop loss isn't the same as direct writing benefits, it's not subject to ERISA, so you don't need to go through that really complicated DOL process where you ask for an exemption to direct write your benefit. You can put stop-loss through the captive. Workers' compensation, sort of, whenever I think about employee benefits, I always get to workers' compensation. You can put self-insured retentions and deductible amounts also relative to workers' compensation through your captive. And so think about what a nice vehicle this could be for someone with a large employee base, where you're doing stop-loss, you do workers' comp, you do wage and hour through your captive.
That would be. And all of those areas are questions that I get, are things that I get a lot of questions about recently, because they are just exploding as a cost for all of our employers. So that's great to know. Since we only have a few minutes left here, and I know it's a temptation, let's say, when you have a captive for to do things or use it for things that maybe you shouldn't be using it for, because it seems like at first blush maybe that would be a good thing to do. So I think it might be helpful to spend a few minutes, maybe just 2 or 3 right now, to discuss what we generally shouldn't do in a captive. And I'm sure you've seen everything across the board. So let's talk about that really quick, so we don't get people in trouble out there, or have them thinking that they should do this when maybe they're thinking of doing the wrong thing.
Right. Well, I know we've said this a couple times, and it bears repeating, in that the captive can't exist just for the tax or the wealth management benefits. You have to have a valid non-tax purpose that motivates your captive. Your captive can't be the owner's personal piggy bank. Like I said, captives are subject to regulation just the way a commercial insurance company would be, and those regulators watch the financials. They watch what you're doing with the assets. They watch the money going in and out of the captive. They watch how much money you're setting aside for reserves. The captive at all times needs to maintain sufficient capitalization, and it needs to be liquid or solvent enough to pay the claims. So you can't be buying yourself any fancy assets, like a personal company jet, or a condo in Tahoe or something like that. It cannot be a piggy bank. It cannot be a piggy bank. Another interesting point is that just because you have some flexibility over the administration of claims, you have to establish the validity of the claims before you reimburse or you pay them through your captive. So real insurance companies evaluate claims for coverage. Your captive is going to do exactly the same thing. Active Captive has a claim department. We facilitate policy writing for the captives we manage, and then we also assist captives in evaluating claims. And you really do need to make sure that the claim is, documented and reimbursable through your policy before you pay it.
Okay. A question that I know I will get, because I do every time we talk about this. Let's say that you've been putting money away pre-tax in this captive for a number of years, and it's built up, and there are needs that you have either personally or maybe even in the business for some of those dollars. So we discussed earlier that once you've written the policies and you're past the run-out period on those policies, then you have profit per se in the captive, and so that could build up to a substantial amount over time. And let's say that someone wanted to, for whatever reason they needed that money. How do you get it out?
Well, your captive can be owned by an estate planning vehicle, so you could make, dividend distributions to shareholders, and those distributions are subject to low tax rates. And so that's a way to get the money out of the captive, is to distribute it. And you need to ask the regulatory body that governs the captive for permission to do that. You can't just write yourself a check out of the captive. And so if, for example, you had a captive with Active Captive, you had a couple of years of a good claim history, you had a clean risk management, track. There was no reason to submit a claim, and you didn't. And let's say you did $1.2 million a year for 3 years, and that $1.2 million went in, and you made your 831B election on it, and it went in tax exempt, and then it was held as reserves for a period of time. Policies run off, reserves run off. You're going to have a nice little a chunk of money inside that captive, and then what we would do for you as your manager is we would approach the domicile where your captive is legally formed and organized, and we would ask for permission to make a dividend distribution. It usually takes 2 or 3 years out from formation before you can do that, and assuming that you have sufficient liquidity and solvency, and assuming that you have sufficient reserves in whatever year you're looking at, the domicile would give you permission to make a distribution, and then you could do that.
Okay, and then just from the tax side, this isn't something we've mentioned specifically on this program, but an insurance company, any of these insurance companies that we set up that we've been talking about are going to be C corporations. And so when you make a distribution from a C corp that comes out as a dividend, and as you mentioned, it's taxed at lower rates, and obviously we never know what Congress is going to do with those rates. They've been, we thought even as late as January 1st of this year that those dividends could be taxed at ordinary rates, but we're still in a situation where those are either taxed at 15 or 20% depending on your income level. So it still is still a preferential tax rate when those things come out. So remember that you have to talk to the regulators, but it is possible if you've run it well to get money out, and it comes out at preferential rates. So one other thing that you mentioned that we ought to talk about real quickly here, we've got a minute or so left, is what domiciles, you've talked about domiciles, what are the most favorable, or where do you set up most of the captive insurance companies? Which states would you set them up, or other domiciles?
Well, there are over 30 U.S. domiciles at this point, and about 35 foreign domiciles. Active Captive Management has, we are licensed, approved captive managers in a number of different domiciles. We do quite a bit of work with Utah. They have a nicely supported infrastructure. They're very responsive to their captives. They're quite great to work with. We have quite a bit of SBUs with Delaware. We really enjoy working with Delaware. Montana is another domicile that we've enjoyed a good relationship with. I feel like this is an Oscar speech, and I'm going to leave someone out. There are some new domiciles on the horizon too that have some pretty new captive legislation that I know we're pretty excited about working with, because from what we see of them, they look like they have nicely supported infrastructure and great people. The first one that leaps to mind in that regard is Tennessee. But there's a lot of them out there. There's more states that are joining the party every day, and the domiciles can be competitive with each other, and they offer different things for captives. Some have premium taxes, some don't. It really runs the gamut. Some allow certain things, certain types of structures, whereas others don't. And so when we look at domiciles, we really try to match the captive we manage to what would be the best fit with a state regulator. And a lot of that has to do with, what their insurance code would allow, what kind of policies we could write. For example, if you have a captive that wants to write itself a punitive damages policy, some domiciles don't allow direct right of punitives. So we look at a lot of things, supported infrastructure in the domicile, what their insurance code would allow you to do with, with assets or with policy lines, that kind of thing. And there's a lot of great choices out there.
All right. Well, thank you for being on today, Dana, and we're out of time, but we appreciate you being here, educating us on this, and we'll hope to have someone else on, if not you, someone else from Active Captive in the near future. Thank you very much.
Oh, thank you. This was great.
Thank you for listening to What About Wealth with hosts Rich Bloomfield and Rick Durfee. Please join us again for another edition next Tuesday morning at 10 a.m. Eastern Time, 7 a.m. Pacific Time on the Voice America Business Channel. Until then, have a profitable week.